It's been a couple of months since my last Freetrade portfolio update, so I thought we'd just jump straight in and see how things are going. Remember that this is a portfolio that I've put together just using UK dividend stocks, and the whole idea of this one is that over many years I'll be able to kind of reinvest those dividends and pretty much snowball this portfolio into hopefully something that might be able to pay future bills and things like that. So first off, let's have a look at overall performance. So I'll jump over to the Insights tab now. So if we can have a little look and see how we're getting on. So I've just expanded this out to the maximum length of time that I've been investing in this Freetrade account. You'll see the money weighted rate of return is 56% apparently, but then more realistic and a lower number is actual time weighted rate of return is 33.24%. And what's really interesting here, if we have a look at the benchmark, which is the VWRL, which is the FTSE All World UCITS ETF, that's performed up 8.5% and this portfolio up 33%, which is pretty nice. Now, this has only been going for, what's that, just over kind of 6, 8, 9 months or so. So I wouldn't judge it necessarily on a really long-term investment, but so far, touch wood, UK stocks have held together pretty well. So let's jump into the portfolio. And first things first, we'll cover off the kind of biggest losers, if you like, and then we'll look through the biggest winners and I'll share all of the rest of the investments as well. So if we look at the biggest loser in the account, there's only actually 3 red ones to be fair, so it's been holding up pretty well. Unilever is the biggest one here, currently down minus 8.89%. This is one of those stocks which seemingly just can't do anything at the moment and can't really catch much of a break. It's a big consumer staples company. Of course, it owns loads of different brands, very much household brands and household names that you'll know and love, and of course can't get enough of. You probably buy a lot of them every single week when you go down to the supermarket. Over the past 5 years, it's been a pretty flat in terms of its returns, but it has been a very reliable dividend payer. And from a positive perspective, even if the economy is kind of going in the wrong way, companies like Unilever should in theory be able to kind of hold their weight and be pretty good when it comes to looking after their customers and looking after their shareholders. So yeah, capital growth, not amazing, but they do have around 4% dividend yield. So if all of your cash was in that and you were looking to live off your monies, then Unilever could be a good place to put it. The next up, and not down too much to be fair, because I have been nibbling away at Legal & General over the past few months, because actually it's quite handy because the share price is so low. And anytime I get a few pounds in this account, I can just chuck it into Legal & General. That's down just under 2%, so minus 1.68% at the moment. As you know, big insurance company, big investment house, looks after various pension funds. Of course, they've got their own investing funds as well that you can actually put your own money into too. They did actually recently release some good results. So they had their operating profits up by 11% with the year before. They also made £2.6 billion in profit before taxes, and their earnings per share was 72% higher than the year before as well. So they've had a pretty good run so far. I think there's plenty of legs in this business, and also it's a healthy dividend payer here. If we go into this holding, you'll see that at the moment it's based around a 6.76 dividend yield. So a very healthy account indeed on this one, and another one that I'll probably just nibble at along the way. And finally, let's look after the other red one, which is only just in the red by a very slight amount. Everyone's favorite supermarket, every little helps, it's Tesco. So this one is currently down minus 0.08% in my portfolio. We'll just have a look at that holding and have a look how this company's been actually doing. Over the past year, it's had a pretty good ride, up over 21%. It's got a fair dividend yield of 3.23%. As you know, it is the largest supermarket chain in the UK by quite some way. The challenge, of course, always is how much growth can you really get when you're already number one. There's a huge amount of competition now from the discount supermarkets, who my girlfriend lovingly introduced me to, and I've been shopping there ever since. Big up Aldi. I wish they were on the stock market and I can invest in them. If we look back a bit further on the chart, you can see since 2017, it's also gained around 50% worth of capital gain too. So it's definitely a long-term hold in my opinion, either way if it's being a loser. So now let's flip things over and have a look at some of the winners. So we'll see in third place in my portfolio is the lovely National Grid, currently up 22.38 or 22.4% approximately in my account. You'll see over the past year it's done pretty well actually, at over 35% capital gain, and it pays a fairly healthy dividend yield of 4.23% at the moment. Now, you would have seen a recent news article about this company, if you've been keeping your eye on the financial news tickers, that the Macquarie Group, which is a big Australian company, have taken a controlling stake in National Grid. So we'll have to see how this one kind of plays out in the really long term. I think the only concerns here are going to be if they saddle the company with lots of debt and then what they kind of choose to do with it. At the end of the day, they're investing in this company probably because it brings in a huge amount of money. It's extremely stable and it's not exactly going to be going anywhere, especially because we don't really have a choice of who provides your electricity at the end of the day. Next up in silver place for biggest gainers is HSBC. So big global bank, lots of exposure to Asian markets and Eastern markets, etc. Not too much reliant on that UK base, so definitely fast growing. Seems to be well priced at the moment. I know when I last look at the kind of enterprise value of HSBC, you're getting it for a decent price at the moment. I think it's got some decent prospects too. Over the year, if we have a quick look here on screen, we're up over 24%. I think, again, I've got fairly lucky with this one in terms of when I actually made that purchase into HSBC. One good thing about the banking sector, of course, is during times where interest rates are going to be looking to be raised significantly, potentially over the next couple of years, and inflation taking hold, the banking sector, touch wood, should do pretty well because they'll be able to make a lot more money with mortgages, loans, and of course, any credit facilities they offer to commercial clients as well. But finally, drum roll please, leading the way, purely out of luck, I think at the moment in these interesting times, is Rio Tinto. So currently up over 24% on my portfolio. As you'll know, this is a large mining company, most of their operations in Australia and elsewhere, and of course headquartered in the UK, again on the FTSE 100. Interestingly enough, if you expand out for the year, you'll see that actually it's only up 10%, but I think I've been pretty lucky when I actually purchased this company. It's had a very good 2021. When we look back on the last year's results, they kind of doubled their net income from 2020. And a lot of that really is down to the commodity pricing. And of course, all the instability that we're going to see in the world at the moment with commodity prices, miners like Rio Tinto are going to benefit. So again, it helps to balance out the rest of the portfolio. And it also means they pay a healthy dividend too, because they've got no idea what to do with all of that money. So they have paid out a special dividend a couple of times. And actually the next dividend, if I'm not mistaken, is due soon. Yeah, that's right. So we already passed the ex-dividend date for this company, which is on the 10th of March. So we are due a dividend soon. Freetrade does say it's got a current dividend yield around 12.45%. So those special dividends, those one-off payments will kind of skew that. So don't expect to get 12.45% every single year from dividends from Rio Tinto. But so long as commodity prices remain high, that you're going to see this. So just be aware though, of course, mining and commodities are going to be highly dependent on those prices. But in good times, take advantage of it, because the rest of the market tends to get a little bit depressed. Of course, whenever you look at things like oil prices, for example, high oil prices tend to then reflect with lower share prices in the rest of the market. So keep an eye on that one. Anyway, quick wrap up in the rest of the holdings. You can see Diageo is doing well at 6.83%. You can see BP is up over 8%. Aviva is doing really well at 16.9%. GSK storming along there 15%, and Vodafone doing well again at 13%, all paying relatively nice levels of dividends. I can't remember the last time I did this update. I think the average yield for this whole portfolio, I want to say, was around 4.5 to 5%, which is a really nice healthy yield. Anytime I get free shares or anything like that from you guys, I put that money straight in, and I think I've got a little bit of money left as well to invest in this account. But overall, we're looking pretty good. You can see here we're up £445 in a £2,000 100 portfolio, which is pretty good. It isn't just a general investing account at the moment, but hopefully over the next many years, maybe even decades, any spare money I'll get, I'll throw into some UK stocks here and grow this portfolio. If you do want to follow along my other portfolios, feel free to jump into the playlist now. I'll put up on the screen. That's with my Vanguard portfolio. You've got my Hargreaves Lansdown one. I'm also going to publish my Lightyear portfolio soon as well. So those are my US stocks that I've kind of nibbled away at during all of this tech sell-off, which is quite a nice platform actually, because there's no commission exchange fees, which is pretty good. Anyway, if you've enjoyed the video, please drop me a big fat like, subscribe for many more, and I will see you in the next one. Thanks again. Happy investing.